Is Paycor a good investment? We'll tell you the bull and bear case for owning this new IPO in about 5 minutes. My name is Brian Feroldi.
And my name is Brian Stoffel.
Brian, Paycor is a company that just came public and it's focused on payroll processing. This is an area that both you and I have made investments in the past and is really exciting. For those that don't know, what does Paycor do?
Right. So Paycor has software, and that software helps with things that are technically called human capital management. That means basically payroll and human resources functions. That means engaging your employees, managing your talent, and that's recruiting, making goals, bonuses, coaching, benefits like health benefits, and then workforce management, which means making sure that all your schedules and your labor management work out. All these things, they become a service that has a really wide moat around it in theory, because when you're using it, you don't want to switch because everybody in your company is plugged into it in one way or another. So when we talk about what the bull case is for Paycor, it's actually pretty clear. This is a software as a service model, which we've seen many companies use successfully to generate enormous amounts of free cash flow. Second, the company in its most recent quarter had very strong bookings growth of almost 80%. We should note that's off of a very favorable comparison to the beginning of COVID lockdowns, but still, that's good news. And third, the company has a massive market opportunity. There are tons of companies out there that still have outdated payroll and human resources software. This would be an upgrade for many of those companies.
Yeah, on the surface, this company checks a lot of the boxes in what we look for in a business. However, we found some interesting things when we thought about the bear case. First off, this company is actually losing market share. It's not growing as fast as the market. One of the reasons why it's doing so is this little tidbit we found right here. This company's net revenue retention rate in the most recent year was well under 100%. That means that they're experiencing significant problems with churn and they're not upselling their existing customer base fast enough to offset that. For that reason, this company's top line growth is relatively muted. Second, the company has a history of making acquisitions to build out its product portfolio. In theory, that should be money well spent if it opens up new revenue opportunities for the company, but we both know that acquisitions don't always pay off and integrating cultures can be a challenge. Three, this company is free cash flow positive, but its free cash flow has been heading in the wrong direction recently. And over the long term, free cash flow is going to roughly track revenue growth. It can't grow any faster than that for an extended period of time. For that reason, if this company can't get its top line growing in the right direction, free cash flow might be under pressure.
So we ran both of those companies through our frameworks. But before we get to those scores, have you ever wondered where Brian and I met? Over 10 years ago, we were both paying members of the Motley Fool's flagship service, Stock Advisor. And since then, we've both become contributors to the service and Fool.com. Stock Advisor has a long history of thumping the market, and many of the great ideas that we've gotten have been through Stock Advisor. If you're interested in trying Stock Advisor out for a year at half price, go to Fool.com/Feroldi.
All right, so how did Paycor score on our investing checklists? For me, this company got a 43, which isn't anywhere close to my investable category. That was really surprising because on the surface, a SaaS business model focused on payroll is interesting to me.
And for me, it was also not a very good score, a 4.5, one of the lowest we've done in this series. Definitely in the fragile category. I will not be looking to buy shares anytime soon.
So, what can this company do to improve its scores over time? First, investors need to keep an eye on a key metric called per employee per month. This is a measure of how much revenue the company is getting for each employee that it has as a customer on a per month basis. We want to see this number maintaining or even increasing over time.
Second, we need to look at the company's customer count. Right now, churn is a problem, and the company is spending a lot to build out its global sales force. For that to be successful, should be able to see that in a rapidly growing customer count.
Finally, keep an eye on net revenue retention rate. Management doesn't go out of its way to call out this number, and that's because it's not doing well. This metric will show you if existing customers are sticking around and if they're spending more. If the company could get this number up over 100% and back into the 100 to 110% range, that would make this company far more interesting to me than it is today. So until they get the churn under control, that's going to be something for investors to watch. Overall, I think that both of us thought initially that Paycor was going to score pretty well, so it didn't score that well, and that was a bit surprising, but that's why you go through the research process.
Absolutely. I know for now I'm going to stay as far away from the stock as I can.
Yeah, I'm right there with you. Well, we hope you enjoyed this. My name is Brian Feroldi, and my mission is to spread financial wellness.
And my name is Brian Stoffel, and my mission is to publish the rules of finance for anyone to see.
Brian's out.